Hello, it's Robert Miner with Dynamic Traders Group for our DT trade strategies for the week beginning Monday, March 8th, 2021. I'm doing something a little different this week for our Twitter, YouTube followers, in that what the video this week is an edited version of the trade tutorial video that I did for our subscribers that was released on Saturday. And there's a couple reasons I'm using that this week instead of recording a unique video. Number one, give you a little taste of the kind of education that we give subscribers. About once a week, we either have a trade tutorial video or we do a big picture report, which usually includes a video, or we do the live recording, I should say, of our live subscribers webinars that we do every 2 weeks. So this is very immediately applicable, and it still is, even though it is one trading day after the fact, because I was looking at some very short-term position of the S&P and particularly focusing on short-term Elliott Wave, how we use it to make specific trade decisions. And since we're right around the same position now as we were then, and what occurred today is very relevant to what we talked about in this video on Saturday. I've shortened it from about 24 minutes down to about 12 minutes. So I hope you enjoy it. I hope you'll learn from it. We're going to take a look at the short-term Elliott Wave counts for the S&P and how we use those counts to help us to confirm or invalidate a trend. And I'm using this example right now because we're at an interesting crossroads, shall we say, particularly in regards to potential short-term wave counts in the S&P. And of course, as usual, I'm using data right up to date. I'm recording this on Saturday, March 6th, and I'm using the data right up to the end of the day on Friday. So I think on Monday, this information may be very valuable. So let's take. So where are we at? What should we expect or not expect? That's what we're going to take a look at today. We're actually going to go down to the intraday data. It gets really interesting. Here's the ES 240-minute data off of the February 6th high. What's going on here? We're going to focus on Elliott Wave, by the way. And the Elliott Wave position, because I think it's going to be really helpful right into this coming Monday. So this is 240-minute data. What's happening here? Well, if we just look at this real quickly, one thing we can say is that it's not a clearly defined 5-wave decline. It's not an impulsive trend on the downside. So it could be one of 2 or 3 different things. Now that's the dreaded alternate wave counts. But as we'll see in a minute, we can really narrow that down to a close-in signal to indicate which indeed it may be, whether it's bearish or bullish. So let's look at the first one. And this is what we would consider a really bearish wave count. We could look at this as a 1, ABC2, and then a 1, 2, and then another 1. This would be making a 2. And if that's the case, we would be on the verge of a 3, of a 3, of a 3. Okay? Which could be extremely bearish. It could be an acceleration to the downside if this is a correct wave count. So why might we want to be cautious about considering this wave count? And is there some rule or guideline or at least some warning that would indicate that may not be the case? And again, forgetting about momentum positions and other technical studies. Well, as I've taught over and over, done lots of tutorials on, the overlap, we'll call it a guideline or a warning, is that if a market is declining, lower lows and lower highs, but then it comes back up, trades into the range of the last decline, that's an overlap, and that's at least a warning that, in this case, the trend's not bearish. Because if we had a strong impulsive bearish trend, typically we don't trade back into the range. Now it doesn't void this 1, 2, 1, 2, 1 wave count, but it's at least a wake-up call and a warning to say maybe something else is going on. So before we continue on, and this is Again, I should have labeled that, but that's last Thursday's low. If indeed this trend is bearish, what should it not do? What would completely void this bearish wave count, or any bearish wave count for that matter? Well, the first thing that would just completely void it would be a trade over the March 1st high, that corrective advance. A trade over that high voids any potential bearish wave count. And we'll either say, as we'll see in a minute, that a correction is complete and a new high should follow, or at the very least, this is all part of a correction, and maybe it'll turn out being a more complex correction. But the point would be, it would not be any sort of bearish wave count, period, end of story, if we're looking at Elliott Wave at least. And if this is a corrective advance, typically, what's the maximum retracement for a corrective advance? Well, it's around the 78.6% retracement. Now, if it goes above it, it doesn't void this being a bearish wave count, but at least it's a wake-up call that says, oh, maybe this is not bearish after all, because that's just typically the maximum. And you do some retracements here, you're going to see both of these were right near the 78.6% retracement. So I'm not going to do that right now. So we know what the market cannot do if the market's bearish, can't trade above March 1st high, and it shouldn't really exceed much beyond the 78.6% retracement. That's a ways above Friday's close. It's at 38.71, closed at 38.40. But the kind of volatility and ranges we have these days is not a big deal. So this is an interesting piece of information that we have. And we're going to refine this in a minute. Let's go on to another, here's 240-minute data. It's another wave count. And that is a 1. This would be a kind of a running irregular ABC. It's actually quite a bearish ABC because the B exceeded the end of the extreme of the 1, and the C failed to exceed the A. So it's not a zigzag, it's more like a running correction, and that would indicate, if that's what it is, quite a bearish market, you know, if it should turn around. But it also gives us the same limits on the upside if this is correct, if the market is bearish. And that is, absolutely can't trade above the March 1st high. And typically, we wouldn't get much beyond the 78.6% retracement. In fact, let me put these in for you here. I'll put these both on and then we'll save them. As you can see, we had the February 24th high, just a little bit, few points at the end of the day above 78.6%. Exactly the same thing here back in March 1st, a few points above the 78.6%, and then turned around pretty rapidly. And we'd also want to do these on the cash data. I'm not going to do it now because that's where they're even more relevant. But just to show you, that's usually about the extent on the upside if the market's making a correction. So this is quite a bearish count also. 1, 2, 1, 2. And if this is the case, we should be within, 30 points. Or less, more or less 30 points, let's just say, of the maximum upside before we continue to the decline. And in this case, it would be a 3 over 3 with the potential of being quite bearish if it should occur. Again, we're not forecasting anything. We're looking at possibilities and limits and confirmations and invalidations. Okay, let's take a look at one more on the same data. And this same data coming down could easily be an A, B, C for a B, and this could be the wave C. It's a nice 5-wave decline into the low on Thursday, a little below the 100% alternate price projection of wave A, which is a typical target for a wave C, and then a sharp reversal against it. So if this is the case, certainly, again, a trade above the March 1st high would say we've probably completed a correction And that has great significance in that not only shall we see a new high, which is really not that far above the wave B high, what I got labeled the wave B high, but it could, the bull trend could continue for some time after this correction. So those are three equally valid wave counts. We're favoring these bearish counts, but all three of these counts show the significance of the March 1st high. And all three of these counts, if we exceed the March 1st high, and then this is either a completed correction or it's part of a more complex correction. But it cannot be part of a bear trend, an impulsive bear trend at that point in time. Now let's focus down. There might be some information that we can use on take advantage of this on Monday. 38.67 up to about 38.74 is should be the limits. Right around there, maybe a point or two above it, point or two below it, but right around there should be the limits on the upside if the market is bearish. So now, friends and neighbors, traders, what would confirm that the higher time frame trend is bearish? Well, at this point in time, we got to take out this wave below. So, and that's quite a ways below the market. That is Friday's low, 37.30. That's over 100 points below the market. So certainly that's a long ways away for a leveraged trader, not so long for unleveraged if you're looking for longer term trends, but certainly for a leveraged trader. Now, if you happen to be partial to, if you believe you understand the position of the market and probable maximum where the market should be if the trend is going to continue, you certainly might think about a little top picking, depending on what happens Monday. But for instance, not a forecast, for instance, if the S&P happens to continue sideways to up into early Monday to around from where it is now, up to about 38.75, and makes some kind of reliable, well-defined reversal that you've used for other short-term trading to enter the market, this would be just a nice spot to do that, as long as you can do it with acceptable capital exposure. Again, if you're the type that likes to pick tops, pick bottoms. I certainly think about doing that when everything seems to be falling together. So right now we got our weekly momentum's bearish, and actually the daily momentum is bearish. And we're not too far from what should be the maximum upside if, again, the market is bearish. So you might consider that. I'll let you use that information on your own. Before we quit, what's one other thing the market could do as an early warning that a top is complete? So typically, what should a market not do? If this trend is bullish, what it should not do is trade below what I got labeled a wave A high. So we can look at this as a 1 or A 2 or B, we're making a 3, and then of course wave 4 should not trade into the range. I just call it simply an overlap. And definitely, if the S&P on Monday should come down and trade below 38.08, this high from early on Friday, that would be an early warning that would say more than likely the bear trend's going to continue. And so that would be a warning way before taking out the wave below. Okay, you got some things to think about. Hopefully this was educational, as well as you can use this information for a potential trade setup on Monday, and at the very least, to recognize what would confirm or invalidate a bear trend, what would confirm or invalidate a bull trend. It's pretty well defined, and interesting situation. We'll see what happens on Monday. I hope you take advantage if we get a setup with acceptable capital exposure. Take care.